So you could have missed the blackout in Spain and Portugal. I wanted to focus on it. It's all about the frequency and the sort of challenge of renewables working with a traditional grid. We've brought on someone who focuses on the battery energy storage sector, which helps alleviate this. Let's go take a look. Welcome back to Vantage. Last Tuesday, we had a very interesting session at our growth conference, focusing on the climate opportunity. Delighted to be focusing on the battery energy storage sector, which is a sort of key component of actually getting the renewables working. Delighted to have James Bustin with us. James, could you introduce yourself, your role, and tell us a little bit more about Gresham House Energy Storage Fund?
Yeah, so firstly, thank you for having me on again. It's been a few months, but it's nice to be back in hopefully a different light, a more positive light as well.
Yeah.
So I'm the Associate Director in the Energy Transition team at Gresham House and the Assistant Fund Manager for Gresham House Energy Storage Fund PLC, or as we often refer to, GRID, because it is quite a long name. I've been in the team since 2019, having moved over from our equities and venture capital division. So I've been on the other side of the investment spectrum, looking at listed equities, and now working on a listed equity fund.
Yeah.
So interesting angle to see both sides. But I've been here since just after the IPO and through various changes in the revenue markets and where we ultimately are at today.
Okay, and the energy storage fund, it's battery energy storage. What drew you to the sector?
Good question. So firstly, it's an energy storage fund. We prioritize batteries at the moment because that's the lithium-ion batteries in particular is kind of the most attractive option for storage. What attracted me in was there's a lot to learn in the energy markets. So coming from more listed equities and tech focus, moving into this, there is a tech element to it. It's the technology that's driving the change in our renewable and energy mix more generally. But it's a lot to learn. And I was interested by that and how we manage it, but also there's an opportunity to look at fund management from the other side of the investment space and how we optimize individual assets and the portfolio of assets. And when I joined, the market was predominantly longer contract frequency response contracts, and we've moved from there to trading ultimately. But as I joined, the long-term plan was we will move to trading. So I was coming in this transitional period as we see the markets develop for batteries.
Okay, interesting. And I mean, you mentioned that this is the second time you being on, and it being a slightly happier time. So last 2024 started off in a very rocky sort of fashion for all operators, and they saw sort of price and revenue declines. But the environment clearly has improved, and Grid's recent sort of annual results showed a 20% rise in revenues to, I think, 46.5 million. And that's to the end of December 2024. And what's driving the turnaround, and more importantly, is this sustainable?
Sure. So the revenues improved quarter on quarter throughout the year, so it's a steady progression through the year. There's two main drivers of that. One somewhat out of our control, but we're doing things on that, so I'll come back to that, which is the revenue rate itself. And then the second one is very much in our control, which is the build out of our portfolio. So through the year, we've increased the portfolio significantly. We're on the verge of reaching a gigawatt of operational megawatts, and we reached a gigawatt hour of operational megawatts through 2024 as well. So we've had significant growth in the underlying size of the portfolio, which contributes to the revenues and EBITDA environment. On the revenue rate side, so you're right, early 2024 and February 2024 in particular, we hit the low points on the revenue rate. It was an environment where batteries weren't being utilized, and we weren't seeing the full trading benefit that we should ultimately see for batteries. So revenues hit a low point. Since then, have progressively improved. Two main factors. One is the utilization of batteries, and then one is just the general market environment. So thankfully, the general market environment is going in the direction we anticipate. So greater renewable penetration, driving a lot of negative prices in particular during the summer, which is the first kind of improvement we saw. But then ultimately, if you're relying more on renewable generation, there will be periods where the renewables are there in abundance and periods where it's not there at all. In abundance tends to lead to negative prices. You see more during the summer when you have solar and renewables. And then in the winter, if you don't have particularly wind power, you then have to find power somewhere else. And that's where your scarcity pricing comes in and you see the upside volatility. Batteries perform really well when there's volatility. What we'd seen through 2023 and start of 2024 was we weren't getting access to some of that volatility, and the volatility itself was suppressed. So we were seeing return to the kind of environment we expect longer term renewables to generate this volatility. And then on top of that, we've seen improvements through the year from it was National Grid, but now NESO. It's been taken back under control. So NESO have been implementing various different changes through the year to effectively use batteries better than what they were. We'd raised several challenges on the issues for batteries, but now we're starting to see that come through. The skip rate, as we talked, assuming last time when I was on, the skip rate is effectively how frequently we're not being taken when we're in merit. That was very high. That's improving gradually. There's a long way still to go, but we saw particularly in Q4 that improved quite a lot, which gives us an extra access to the balancing mechanism to help with our trading environment. So all of that contributes to an improving revenue rate, as well as an overall bigger portfolio, which ultimately will lead to further improvements going forward. So we're in a good trajectory. We're not where we ultimately want to be longer term. There's still opportunity as renewable penetration grows in particular.
Okay. And there's a significant portion of your revenues now seem to be covered by this tolling arrangement that you have with Octopus Energy. How's this sort of strategic partnership working, and what benefits and stability does it bring to your revenue line? And then if there is potential for other such sort of partnerships or with other energy providers.
Yeah. So we implemented the tolling arrangement in Q2 of last year on the back of the lower revenue environment we saw. The aims of that was to give more clarity and comfort over revenues longer term. So we signed a 2-year agreement with Octopus Energy for roughly half of the portfolio. What a tolling arrangement does is it takes away the full merchant exposure and replaces it with a contracted earnings base. So it can mean you lose on some upside if the revenue environment improves, but you're protected against the downside, as we saw in February. What's interesting with that deal was we were able to sign at attractive rates versus where merchant levels were. Reason being is there's extra value for particularly on Octopus Energy, which has a large renewables base. And this came from a trial that we ran separately a long time ago, which we implemented through this. So we used that trial information as we saw the revenues fall away to go out to suppliers and promote the use of batteries in their portfolio. And what that gives someone like an Octopus Energy is, whilst they can trade a battery normally, like you would as any old optimizer, you've also got your renewables book, so you can help balance your volatility in your own book as well. So it gets rid of some of the imbalance costs that they would have in the rest of the portfolio, which adds an extra layer of value in that. That's one way of contracting, though, and we often talk to that as kind of vertical contracting. So if you think of every asset lined up, it's taking blocks of assets and fully contracting those. Alternate ways you could contract horizontally and effectively hedge across the whole portfolio. To do that, you would contract a proportion of the revenues and leave the rest open to merchant. That's often referred to as a floor contract. So with that, you don't lose the upside. So if the merchant environment improves, you enjoy the full upside. There's a share usually with the floor provider, but you are protected on the downside. And those rates are typically lower than a toll, but you have the merchant upside. So between those two, that's what we're looking at doing more of. It gives greater clarity on where our revenues are going, but also it allows us to do things like raising new debt or refinancing, which we're currently working on at cheaper rates than what we've had in the past. So taking away the merchant exposure, giving a contracted base for
it's effectively a stable revenue line, allows you to take away some of the cyclicality and hopefully fund things at a better rate. I know we understand that. Okay.
Yeah, so we've been keen to maintain a blend of contracted base with the merchant upside. We did that for 2 years with the tolling. A floor could be done across the whole portfolio, and each asset has the merchant upside. So it's a balance between those.
Now, quite a lot of focus on the government's energy policies, but reading through the lines seems to favour the sort of battery energy storage sector in particular. So UK government's Clean Power 2030 action plan seems supportive. The net zero 2030 sort of targets being set out also seem to be supportive. What's your view of that, and then how are you positioning yourself to take advantage of this opportunity?
Sure. So firstly, it is very positive. I'll probably refer to CP30 rather than the full
Of course.
Clean Action Plan.
Yeah.
But CP30, it doesn't necessarily favour batteries, but at its core, it's looking at 2030 as a date and saying, how do we get to net zero in that time frame? Batteries are the only feasible option for flexibility. So whilst the renewables is being built out en masse, you need flexibility to go alongside that. You've seen issues in Spain recently where you don't have the flexibility to catch frequency deviations, for example, and you don't have something that can respond instantaneously to changes in the network. Batteries offer that, but they also offer long-term storage for that renewable generation as well. So you need that flexibility to go alongside it. And when we're looking at 2030, if you have renewable space, you need some storage. And the plan in there is, how do we get to the requirements for storage in that time frame? Well, batteries are the only thing that can be deployed en masse, and also the cheapest option. Cheapest in terms of upfront capex, but also cheapest in terms of running costs. They have a high round trip efficiency, for example. Other storage requirements, you lose a large chunk of what's generated whilst you're trying to store it and then put it back into the grid. So batteries are the clear winner for how we get there. So whilst it's not specifically favouring batteries, by its nature of what it's trying to achieve, batteries come out on top. But it's very helpful, because previous dialogue with government has been looking at 2035, 2040, 2050, long-term outcomes, which allows policymakers to hope for new inclusions into the market, something to change, something revolutionary to change the energy sector. If you move it to 2030, you have to actually look about what's feasible and available today. And that is batteries. So it's very favourable. Sorry, I might have missed the end of the question. How we're setting up for me.
Well, how are you taking advantage of it? I think is I think so. We think it's got to benefit the sector. How are you planning to sort of capitalise on it?
Yeah, so there's a few ways in which it's benefited the sector. One is obviously the need for batteries and future growth opportunity, but also that pressure is now going on to NESO in terms of utilising batteries. So I talked about the skip rate issue. That's helping to move those things along, which opens up the revenue opportunities for batteries and the investment case. What's also happening in the background is something referred to as queue reform. So it's looking at the queue of batteries on the system. There's way more than that is needed, but ultimately it's looking at what can be delivered quickly. So there'll be a lot of projects that fall out of that queue. We're in a very good position with the fund of having a very substantial pipeline in a very good position in the queue. So the position is secured and we're able to build those out. So we're now planning the next phase of the fund. So we've built out later this quarter to 1072 megawatts, and we're now looking at how do we grow out from there, capitalizing on the need for 20 odd gigawatts of batteries as well as long duration. We haven't touched on that, but there's additional circa 8 gigawatts of long duration requirement on top of that as well. All of this is pointing to need for batteries, and we're just making sure we're positioned in a way where we can keep deploying batteries and maintain our scale. We're currently the largest battery portfolio, and we aim to keep it that way. We have circa 695 megawatts, 94 megawatts of new pipeline, which we're looking to build quickly. We have gigawatts worth of pipeline behind that as and when the opportunity comes to bring those in. But also the existing portfolio is average 1.6 hours once we get to 1072 megawatts. We're looking to bring that to 2 hours as a starting point, but there's opportunities to go to 3 or 4 hours if the opportunity on a revenue side is there. So there's significant investment opportunity within the fund and also new projects, and we're making sure we're in a position that the new projects are ready to go in the queue and augmentations are ready. We've done all the planning and application work to have these projects ready to go as and when funding is available.
Okay, and so just to clarify, the opportunities within the fund, is that just optimizing assets that you already have, or is that thinking of those, expanding those assets as well?
Yeah, so it's both are kind of combined. So as you're expanding the duration, essentially you're improving the assets, and that's what we're looking to do. So we're taking some of the shorter duration assets. So the average is 1.6 hours, but we've got a mixture of 1 or less hour assets, and we've got some 2 hour assets. The aim is to bring the shorter ones up to 2 hours, because that's where ultimately the optimal revenue rate is at the moment for batteries. But because also in the background, battery costs have fallen quite substantially, there's a real opportunity to make significant cash on cash returns by investing into the assets we've got, adding more battery capacity to extend duration, improving our revenue rate. With doing that, you typically don't change your cost base much. If at all. So it flows straight through to EBITDA and earnings, which greater cash flow for shareholders as well. So the really attractive return is on the augmenting the current sites to at least 2 hours today, and then potentially further in future. And that's what we're looking to do in the first phase.
Okay. And all this capacity expansion that you're talking about, how is that going to be funded?
Good question. So we've talked already in the market about our funding arrangements. We have a debt facility in place at the moment.
Mm-hmm.
We expect for that to peak around 165 million of net debt. We're looking to refinance that, and this is where the contracted revenues is really important. So we're looking to use contracted revenues to underpin our financing arrangements going forward. Typically, we're mostly merchant focused with our debt arrangements. By moving to contractual arrangements to cover our debts servicing, it allows us to get cheaper rates, longer terms, and just an overall better facility for the fund. So this is where floors might become interesting, of guaranteeing a contracted level which covers our debt servicing and all the fund costs and everything in between. And then the merchant is allowed to flourish on top of that, which provides the dividend environment and the equity boost on top of that. So that's what we're focused on next. So the refinancing, we're pretty close, and hopefully some announcements soon on where we get to with that. But there'll be a slight upscaling of the initial operational facility. The use of those proceeds will be for the augmentations. And then on top of that, we're looking at doing the 694 megawatts of new pipeline. Each of those will be in a separate project finance facility, which prevents kind of cross-collateralization between anything. But we'll be announcing more in due course as we go further on that.
And I think you started touching on it, but let's get just to clarify that. The 3-year plan talks about reinstating the dividend as a priority. So you've got these sort of various demands on you in terms of cash going into capacity expansion, etc. What are the factors needed to happen for you to get the dividend reinstated? And what kind of policy are you anticipating putting to shareholders? So, in terms of how what level of payout they're going to get?
Yeah. So the 3-year plan was a fairly ambitious plan we put forward to the market. Treated with some skepticism initially, but hopefully as we get further forward with the contracting and the debt arrangement, that starts to become more feasible, and the market starts to appreciate that. But financing is the first part of the 3-year plan. That unlocks a few things. One of them is the distributions, but another is the ability to build out the augmentations and the new pipeline. So it's 3 core parts to that. In addition, we also talk about additional revenues, but that's the funding isn't required to deliver on that. That's the next stage of how we optimize the assets further. On the distribution side, so that will obviously be a board decision, so reserve that for them. What we anticipate to be the case is a focus on full coverage of dividends. We've always prioritized covering our dividends. We don't see long-term future in paying out capital. The plan will be probably a smaller level of dividend and 3/4 a smaller level, and then a final dividend to kind of make up the difference. And the overall policy will be announced post the refinancing. But the refinancing ultimately unlocks the dividend returning. So we made arrangements last year when revenues are weaker to kind of protect cash and ensure build out of the operational capacity, because that drove longer term free cash flows for shareholders. So that was the priority. The refinancing is one step in moving past the build out phase of that original portfolio, and now frequently available free cash flows. Contracted base provides longer term kind of security on where revenues are going to be as well, so we can start implementing a dividend policy. The plan we've announced to the market is circa Q3 in relation to Q2 as the first dividend, and there'll be a full announcement on the plan at that point, but smaller initial dividends, final dividend to make up for it. But what's interesting and what I really want to highlight is the opportunity here for shareholders, we think, is very much on the investment side at the moment. Battery costs have fallen substantially. Augmentations present a very significant return on your investment, but also a very quick return on your investment. So it typically takes up to 3 months to build one of these augmentations, so it's added additional capacity. We've done 8 over the past year at 330 megawatt hours, so we've got a good track record of how to do this now. We want to prioritize moving money into that to facilitate it, and we've talked about the debt arrangements being upscaled slightly to cover that. So that will be a first part alongside the distributions, and then obviously further funding for a new pipeline. The reason we want to do this is we've seen some market transactions, for example, Harmony's deal recently, as a touch point for the market on where a 2-hour asset is valued. The augmentation brings our portfolio to an average of 2 hours. So it's a helpful indicator of where value is at the moment. But even looking at new projects, all of those are 2 hours planned originally. There's scope for more if there's an opportunity, but let's say we're building 2 hours. The cost of that might be somewhere 450 to 500k per megawatt. Harmony's transaction implies 860k per megawatt. So there's a large value increase on creating an operational portfolio. And that's what we're looking to try and unlock with the 3-year plan. And that's why we're being quite ambitious with our aims. But ultimately, that's where we deliver significant shareholder growth. And with that growth comes additional free cash flows and greater dividend paying ability longer term. So it's a balance of all of those, which we'll look to announce.
And interesting. I mean, you're touching on, a look through to valuation on the value that you created. I mean, the share price has recovered. They're still trading at a 40% discount to NAV. And it sounds like actually scaling up and getting this sort of visibility around sort of operational assets is one way of narrowing it. Hopefully a dividend is another way of sort of narrowing it. What are the factors contributing in your mind to the discount, and then the tools you're going to use to sort of narrow that discount?
For sure. So it's definitely not a favourable environment recently for shareholders. All of us in the fund are fairly substantial shareholders in ourselves, so we feel that pain as well. We have done a few things to address some of the pain in terms of changing our management fees recently, and to be a blend of market cap and NAV, so we reflect some of the discount in the management fees as well. But ultimately, the discount there's a few factors at play here. So one is the investment trust space in general, with large discounts across renewable investment trusts. So there's that in play. There's funds have moved away from the space to an extent, which has reduced some of the buying opportunity, which is why they tend to stay down at that level. But you've seen Harmony with the transaction announcement. The liquidity event creates a positive momentum, and actually shares are trading higher than what the offer price is at the moment. But in terms of our own fund, I think there are some sort of questions hovering over the 3-year plan on the execution side, which is rightly so. Everyone's complimented us on being ambitious, but they want to see the execution of that. The refinancing will be the first step. Contracting revenues provides visibility. Beginning the pipeline is the next step. So we're working on all of those, and hopefully announcements very soon on each one of those points, which helps provide comfort on the direction we're ultimately trying to get to. In terms of bridging that gap for now, I think there will be a hold until we start demonstrating some of that, but I would hope once we start announcing it, the evidence is starting to come through of where it should go to, and then we can start using the read-across as an example of, okay, well, if there are two parties bidding for a similar asset pool, how does that translate over to the growing size of the portfolio? Because we talked about the cost to build versus the value of operational. That's in addition to where valuations are today on the portfolio. In fact, none of that is included. So there's further gains potential for this fund. First step is bridging that gap. Obviously, some shareholders reacted when the dividend was cut. Our focus, as we've always said, is on paying that out of available cash flow rather than capital. Announcement of the dividend hopefully starts to remove some of those questions on the stability of the company and the direction. So hopefully in a month or two's time, we could be having a very different conversation, but we'll see. We're positive on the direction for the fund, and hopefully the share price starts to reflect that.
I think that's a good way of sort of wrapping it up. So I'll summarize it. Happier time than last time, but many, many more opportunities to come, I think. And it's really about, you've set out a very clear plan in terms of how you're going to plan to execute that in what looks to be a reasonably sort of favorable environment. So it comes down to, the execution and delivery against that. We will keep a very careful eye, and we wish you luck.
Thank you.
James, thank you very much for coming on Vantage.
Thank you for having me.